We had a fairly large red week in the S&P 500 overall. Many companies are in fact down and quite significantly, and there should be no surprises as to why we are seeing a pullback right now. Just take a look at the forward P of companies in the market, a lot of them trading very high, and these numbers are above what we consider the modern era average of the S&P at around 20. We also notice market sentiment is shifting. Around a month ago, we were sitting in greed. Right now, we're firmly in neutral, and this is definitely something we do like to keep our eye on from time to time. Now, in today's episode, we are looking at 5 undervalued stocks near their 52-week lows. The first one is Johnson & Johnson. For those that don't know, a multinational company. They develop, manufacture pharmaceuticals, medical devices, as well as consumer health products. If we look at the company itself, as we said, trading right there towards its 52-week lows, we get a double buy rating from Seeking Alpha and Wall Street, a hold from Quant, and as we will come to show you, not only is this trading at a very attractive yield of 3.4%, but that is significantly above the 5-year average, and also as a side point, they are a dividend king. We can also note their forward PE sitting at 14.7, again below the 5-year average. Now, over the last 12 months, we can't kid ourselves here, they haven't had a great performance at all, down around 6%, and over the last 10 years, they are up but only 38%, and that translates to underperforming the S&P during this period. Now, for each one of these companies, we are going to take a look at several factors, the first one being their earnings expectations, and with J&J, over the next 4 quarters, they only anticipate one of them to be a growth year on year to the earnings per share. One thing we do like though, over the last 4 quarters, they have a 100% track record outperforming management targets, so good historical forecasting accuracy, which in turn, over the next full year, gives us confidence they will hit the EPS estimate of 10.62, there in turn lowering the forward P to 13.8. We also want to highlight something for each one of these companies, and that is the growth grade, because yes, while some of them do lag the sector median, we still believe, for reasons we will come to in our valuation, that they are undervalued, have a lot of upside, and definitely strong companies to consider in your portfolio. In terms of Johnson & Johnson, as we can see here, over the next 3 to 5 years, they are anticipated to grow their EPS by 5.3%, comparing to the sector overall, that sits at around 10.9%. Now we get our dividend safety score at 99, very safe, the highest score obtainable, as we will come to show you a double severe undervaluation signal now, and they did increase their dividend in April this year, 4.2%, that is pretty much in line with the average inflation rate sitting at around 4%. Now it was reaffirmed back end of October, very safe score, and this ultimately means for J&J a dividend cut is highly unlikely. Again, for each one of these 5 companies, we will analyze key metrics, effectively seeing how they performed in the 07-09 Great Recession. While J&J, they increased the dividend, they had above average growth, -6%, the S&P -12%, and they also massively outperformed in terms of return, -27%, the S&P -55%. As we said, inflationary increase this year. However, over both the last 5 and the last 20 years, we have seen a higher increase on average, 8% in fact over the last 20. And as we mentioned, they are a dividend king with 50 plus years of consecutive increases, but they've also been paying a dividend for the last 108 years now without a reduction. Now, the first valuation model we are using, and do bear in mind, we're not looking at any of these in isolation, as we will conclude through our own valuation process towards the end of each analysis, but the blue tunnel effectively telling us the expected fair price. Johnson & Johnson for the large part of 2024 has in fact been lower. Right now, the gap is quite wide. That is an indication here of severe undervaluation, and that is backed up when looking at these 2 models. The dividend yield theory, that tells us a company is undervalued when the current yield sits above the 5-year average. 3.38, not only above the 5-year rolling of 2.73, but that is now the highest yield they have offered over the last 5 years, and higher than the COVID drop that did see that not too far off the current level. Forward P also giving us another severe undervaluation signal, 14.4 below the 5-year 16.5, and we can also note it is trading marginally at a discount to the overall healthcare sector at 15.5. Then we move to the free cash flow payout, and remember, on this channel we will draw your attention to the free cash flow over the earnings, which is susceptible to manipulation by management through accounting. Below 60% is what we want to see. Pretty much a blanket rule, gives us faith they can offer nice dividend increases. Now, it has been below that every year, bar the last 2 years. Nice to see though, over the next 12 months, it is anticipated to come down to 61%. Then we're going to look at the free cash flow for each company in terms of the per share increase. We want consistent increases over the longer term. We don't get consistency, but we do get growth from 533 to 702. And we also identify that over the next 12 months, it is anticipated to have a nice jump to $8.19. In terms of sales growth, we want to identify companies at least 3 to 7% year on year. 3 to 4 is just to keep up in line with inflation. Now we can see over the longer term, you probably could argue a 3% average, but very inconsistent. 2 of the last 10 in fact being negative, and as we can see, the numerical format below. One thing we want to identify, are there any companies that return excess cash to investor pockets through those share buybacks? And we can see J&J, for the large part, whilst inconsistent, have done that over the last 10 years, and they've bought back around 430 million shares. As we said, a nice added bonus on top of those dividend increases. We then move on to the ROIC, one of our favored metrics. 10% or more give us faith management are able to effectively allocate their capital. Looking very good, very consistent over the last 10 years. 21% also strong on a trailing 12 month. And then we move to the operating margin. 2 things we want to identify. 1, is it above the minimums? Yes, we can see that for J&J. Second one, are there efficiencies? Is when the margin increases over the longer term. Now we don't get that, but as we can see, nice consistency at a very attractive rate. And the same is to be mentioned here for the free cash flow margin, a very strong, consistent as well free cash flow machine. We then move on to the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. Below 3 is what we want to see, and why we highlight this as a key metric, it correlates to the dividend safety, balance sheet strength. Now remember, the numbers you see below are the number of years it would take the company to pay off all of their debt net of cash on hand. 0.51 on a trailing 12 month, 0.49 over the next 12. Very strong balance sheet, and as we saw, 99 on the dividend safety. Now let's jump into the valuation model for J&J, where we get an intrinsic price of $175. That is ultimately the average of these 3 models. Now typically when we do our deeper dives, we do run through every single one of these models, talking about the inputs and outputs. Let's jump straight into it today, where we do factor in a 10% MOS. We execute on this if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that for J&J will a buy up to $157, then we keep going till it's near the current trading price. Now it's not at the 20% level just yet, that would be 140, but it is up to 15% MOS at the $148 mark, which for a dividend king, the yield very strong, very high, no worries with the dividend safety, and they've been paying a dividend even without a reduction for around 100 years plus. So definitely one to consider. On top of that, we can see Wall Street themselves giving this a price target over the next year of $178, which translates to 22% upside over the next year. And as always, give us your thoughts as we do go along these stocks today. We also want to let you know we have released our latest free weekly article where we run through one stock we are buying heavily in the month of December. Now we release one to your inbox every Monday morning. We highlight severely undervalued stocks for your attention, as well as what's gone on in the market over the last few days. So click below, you can sign up and start reading straight away, where you'll also be able to gain access to 28 undervalued dividend stocks for the month of December. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, a recently released copy of 29 stocks that Wall Street believe right now in the S&P 500 have the most upside. So as we said, click below, you can sign up and start reading straight away. We then move on to the next company, PepsiCo, which is also a dividend king. Now they're a multinational company. They produce and market beverages, snack foods, and they have some well-known brands. We're talking Pepsi, Lay's, Gatorade, as well as many, many others. Now we also notice that this one is trading right there at their 52-week low. We actually get a triple buy rating right across the board. A very attractive yield, again, very similar position to J&J, where that is well above the 5-year average, as well as the forward P trading at 19.4. In terms of their performance, well, not great over the last year, down 8%. Over the last 10 years, they are around 66.5. In terms of their earnings, always love to see this, green right across the board. They're anticipating growth every single quarter over the next year, whilst also outperforming over the last 4. In terms of their expected EPS, their next full financial accounts, we can see that will in turn lower the forward P to 18.33. In terms of growth, well, they get a C-. Again, we do want to compare this for all of the stocks today. 5.6%, whereas the sector median marginally higher at 7.53. We get another dividend safety score in the very safe bracket at 93, as well as another severe double undervaluation. This one, unlike essentially J&J, they have increased that dividend at a high single-digit rate of 7.1% above inflation in February this year. In terms of the key metrics from the last recession, they increased the dividend. They had above average growth, pretty much flat, whilst also outperforming the S&P with their negative 35% return. Pretty consistent over the last 5 years in terms of those increases, but over the last 20, it has been a double-digit rate at 11%. We already mentioned a dividend king with 51 years of consecutively increasing the dividend. Then we move to this first valuation model where we can see, pretty similar to J&J, a lot of very large blue chip dividend stocks have been neglected by the market, as we can see here showing undervaluation all of 2024. And then we look at dividend yield theory. We already mentioned severe undervaluation here as well. 3.43, well above the 5-year rolling, as well as the forward P 18.6, well below the 5-year 24. And we can notice it is only marginally now trading higher than consumer staples at 17.8. In terms of looking at the free cash flow payout, well, below 70% for this industry, little bit of a red flag indicator that the trailing 12-month is triple digit, not something identified by looking at the earnings data. When it's triple digit, this tells us that management paid out more in dividends than they generated in free cash flow. However, the key takeaway here is over the next 12 months, it is anticipated to drop down to 70%, which is ideally what we want to see at the maximum level. Free cash flow, pretty inconsistent over longer term, expected to grow quite massively over the next 12 months, but just bear in mind the type of companies you are analyzing and have those realistic expectations. In terms of sales growth, not the greatest in terms of consistency. Last few years looking very good, but if you do zoom out, there have been some years which has been quite difficult for them, and we can see the numerical format pretty much showing us that below. Shares outstanding, pretty similar to Johnson & Johnson. Yes, they have done some share buybacks, but fairly trivial and not part of management's capital allocation priorities. ROIC, very consistent, no worries whatsoever. Again, pretty much copying what we have seen from Johnson & Johnson in the very high teens, 20% on a trailing 12-month basis. And whilst we don't get any operating efficiencies, we do see it pretty much straddling around that minimum level at 16%, something that we can equally say for the free cash flow margin. In terms of net debt to EBITDA, whilst not as strong as Johnson & Johnson, well below the 4, from the highs of 2020 at 2.66, it has been coming down gradually, 1.95 on a trailing 12-month, anticipated to go lower over the next 12. So whilst management's capital allocation priorities doesn't seem to be right now giving a lot of share buybacks, what they are focused on doing is paying down debt and delevering the balance sheet. Now, intrinsic value at $173 for this company does now pretty much give us around the 10% MOS we have at $156. And we also notice Wall Street very bullish, upside of 18%, price target 185 over the next year. So if you are looking for dividend kings, then PepsiCo as well as Johnson & Johnson could be ones to seriously consider. And as we saw, they do pay a very attractive dividend, higher than the 5-year average. Both dividend safety in the very safe category, but as always, do give us your thoughts below. We then move on to the next company, which is in the railroad industry, CNI, Canadian National Railway. They're a transportation company. They provide freight rail services across both Canada as well as the US, and has had a similar fate to the previous two companies, trading right now at its 52-week low. A buy from Seeking Alpha, whilst we get a hold from Wall Street, 3.5 to flip them to a buy, so not far off. However, a very strong hold from Quant. In terms of yield, 2.28%, forward P just above 20. Over the last year, down around 13%. over the last 10 years up around 58%. And when we take a look at their earnings over the next 4 quarters, they're anticipating 3 of them to be growth. Also bear in mind, this isn't a cyclical industry. Out of the last 4 quarters, they have been in line or outperformed for 3 of them. Most recent one was a marginal beat. And we can see over the next 4 year growth anticipated to the EPS, which in turn will lower the forward P for CNI just below 18. In terms of growth, not the greatest at a D-, and we can see the earnings per share over the next 3 to 5 years, 8.5% as opposed to the sector median at 11.5%. We then have another very safe dividend score, another double severe undervaluation with a very attractive 7% increase in January this year, letting us know next month we are expecting another increase. In terms of the last recession, while they increased the dividend, they had average growth whilst also marginally outperforming the S&P 500 with some very nice double-digit growth over both the last 5 and the last 20 years. They're also a dividend aristocrat with 25 or more years of consecutively increasing the dividend. And when we get to the first valuation model today, zooming in over the last 12 months, whilst not massively undervalued for the whole year, we have pretty much seen from around September, this company is lower than the bottom end of the intrinsic price. Right now, severe undervaluation, which is also mirrored in terms of the conclusion, with the yield being higher than the 5-year and the forward P being lower than the 5-year rolling. In terms of the industry, right now it is trading at a discount to industrials, which sits at 21. But remember, some companies do deserve to trade at a premium. Some companies deserve to trade at a discount. The question we need to understand is this company one of those that fits that criteria, or is the market overreacted? Free cash flow payout pretty much below 60% for the majority of the last 10 years. 63 over the next 12 months may be something to keep an eye on, given it has gradually been increasing from 2021. In terms of the free cash flow per share, inconsistent, although it has doubled from 2014. But as we can see and have mentioned, it is a cyclical industry, which is shown on their top line with 3 of the last 10 years, notably the most recent one being negative. When we do zoom out as well, we can see their top line increase by around 50%, but we can see a lot of years of inconsistent movement. What they have done pretty strongly, especially in comparison to other companies, are those share buybacks returning excess cash, and that is something we can see is very consistent, so clearly this one is one of management's top priorities. ROIC looking good as well, above the minimums, no real complaints with that metric. And whilst the operating margin doesn't give us efficiency signs, massive and very consistent, something we do love to see, pretty much in the low 40s year on year. With the free cash flow, again, absolutely no complaints. And that is pretty much what we want to see in a company. When we do dissect some of the metrics, we don't want to see any red flag indicators. Net debt to EBITDA, the only thing we would mention is, yes, it is below 3, but from 2021 it has been increasing. Nice to see a marginal drop anticipated over the next 12 months, but the industry that this company is in is fairly capital intensive, so we aren't surprised, just something we would say to keep an eye on. Intrinsic value then, and bear in mind you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it is for CNI or any others. When we do apply the MOS today, you will see that we have actually quite a sufficient and attractive margin of safety at 20% around the current value, and we also notice Wall Street themselves, nice upside, $128, with that being 24% over the next year. As always, let us know your thoughts. We know some people do like other railroad companies, but right now for us at this company, you could probably argue as well Canadian Pacific, Kansas City are looking undervalued in relation to others. We then move on to Nike, which is a massive global brand that design, manufacture and sell athletic footwear, apparel as well as sports equipment. Very well known. The brand itself is probably one of those most recognizable around the world. In terms of the performance, well, at its 52-week lows or thereabouts. In terms of a buy signal, we only get one from Wall Street today. In terms of the yield, over 2%. Forward P, fairly high, but we will compare that to the 5-year average. Down massively, negative 36%. They have had some very poor quarters, although this is a company that Bill Ackman himself has taken advantage of and bought the dip. Over the last 10 years, up around 63%, although we can see all-time highs for this company sitting around the $180 mark in November 2021. We're talking more than 3 years ago. In terms of their earnings, well, we can see harder times are still to come with only one growth out of the next four, but they have seen a 100% historical forecasting accuracy. And if you believe May 2026, what they estimate that far out, the forward P in turn will lower to 24.3. In terms of growth, they get a D grade. They are anticipating 8.4% increase to the earnings per share, with the sector median coming in at 10.4. Now we're pretty much on our fourth very safe dividend score at 99, with our fourth double severe undervaluation signal, and just last month they did increase that dividend at an attractive rate at 8.1%. In terms of the key metric, they increased the dividend in the last recession above average growth, whilst also massively outperforming the S&P negative 36%, and some very attractive increases, 15% year on year on average over the last 20, and they're not far off, in fact 3 years away from becoming a dividend aristocrat, whilst also paying a dividend for the last 40 years without a reduction. Now, over the last 12 months, we have noticed quite a common theme with a lot of companies today. They have just been trading at such an undervaluation. The market, for whatever reason, has put them aside, maybe taking a look at other faster growing companies like semiconductors, and therefore they have been neglected. And that doesn't necessarily mean they are bad companies. And as we have shown, a lot of them right now are giving us some severe undervaluation signals. Now, you may think the forward P of this company is very high, and that is something we can agree with. However, on average, over the last 5 years, it has been trading a lot higher, nearer the 32 mark. No surprises then, it does trade right now at a premium to the consumer discretionary overall. In terms of the free cash flow payout, below 60% is what we pretty much get year on year. Although over the next 12 months, it is anticipated to go very high. Definitely something we would say keep your eye on. And the free cash flow per share has been increasing again, but we do note a lot of inconsistencies year on year, with a drop over the next 12 months anticipated to $1.70. In terms of sales growth, well, 2024, a very poor year, 0%, trailing 12 month, -3%, and this is something that has come up in their earnings. They are going through a very difficult time. Question is, do you believe these difficult times are here to stay for the company? Are competitors now taking over their market share, taking over essentially the clientele that they did have in years prior, or is this just a small blip in the road like Bill Ackman has thought and has taken advantage? Shares outstanding, again, we can see they have done share buybacks over the last 10 years, but very minimal, definitely similar to Johnson & Johnson as well as PepsiCo. In terms of ROIC, no real complaints. Majority of companies we have looked at today have looked very strong in this department, as well as essentially on the consistency levels. And in terms of the operating margin, we can see consistently around the 12% minimum, and the free cash flow margin looking pretty healthy, 15% on a trailing 12 month. Now, no surprises that all these companies with very safe dividend scores have one thing in common, and that is the net debt to EBITDA looking very good, the balance sheet looking very strong. 0.28 over the next 12 months is still very, very attractive to note. In terms of our valuation today, just under $100, which will emphasize a very nice MOS at 20% around $80. Not quite at the 25% level just yet, sitting somewhere between 20 to 25, with Wall Street themselves bullish, 21% upside, $93 price target over the next year. We then move on to Novo Nordisk, a global healthcare company specializing in the development and production of treatments for diabetes, obesity, as well as other chronic diseases. And we can see this company trading right there towards its 52-week low, a double buy rating with a hold from quant. The yield is on the lower end of companies that we have identified today, with the forward PE sitting at 33. Now, over the last 12 months, they are up around 8%, although massively underperforming the S&P. Over the last 10 years, though, massive outperformance, up 388%. And in terms of their earnings, the next 2 quarters, they are expecting double-digit growth, although we can see they did have a miss in their most recent Q2. December 2025, massive growth expected, which in turn will lower the forward P to 27.7, as we will come to show you that is below the rolling average, and probably the first one today with an attractive growth grade at A-, and notably their earnings per share is above the sector, 15%, sector median 10.9. Pretty much all companies we have looked at today have showed us this very safe score. We get 99 for NVO. We'll cover these 2 valuation models with a very attractive dividend increase of 52% over the last full year. In terms of how they formed in the last recession, they increased the dividend. They had plus sales at 6.1%, whilst also massively outperforming -27. They're also a company that isn't shy for giving double-digit increases. In fact, it sits at 21% on average over the last 20 years, and they are a dividend aristocrat with 27 years of consecutively increasing the dividend. In terms of looking at the 5-year average P ratio model, we do identify that this company, unlike others, has actually been trading at an overvaluation for the vast majority of 2024. Right now, it is trading towards the lower end, so you could argue reasonable valuation, but you could also argue slight undervaluation. In terms of dividend yield theory, we see it pretty much around the 5-year rolling, and with the forward P, we see it below. So again, you could argue, based on all of these signals, reasonable / slight undervaluation, although we do see it trading at a massive premium to the overall healthcare sector. And as we will come to show you, based on these metrics, based on previous analysis, it does deserve to trade at that premium. Doesn't mean you should buy it. As always, we do need to factor in a margin of safety. In terms of payout ratio, well, below 60% for the majority of the last 10 years, 60 in 2023, anticipated 52 over the next 12 months. And when we look at the free cash flow, probably the most consistent we have seen today, with 3 times growth over the last 10 years, a nice jump to just under $20 expected over the next 12 months. And whilst we do notice inconsistency in the sales, the last 3 years, as well as the trailing 12 month, are showing signs of strong double-digit increases. And just look at that, over the last 3 years, pretty much around a 3x, with this company also not only giving you double-digit increases to the dividend, but even if they are fairly trivial, also incorporating share buybacks into their capital allocation program. ROIC, again, this is very obvious, the best one we have seen today. In fact, 1 year they had triple digit, 2023, 72%, 67% on a trailing 12 month. And the operating margin, we get marginal signs of operating efficiency, but very high numbers in the low to mid 40s, and the free cash flow, like the majority of companies today, giving us that free cash flow machine signal. In terms of net debt to EBITDA, absolutely phenomenal, not only below 3 on a trailing 12 month and over the next 12 months, 0, indicating to us it won't take NVO 1 day to pay off all of their debt net of cash on hand. Now our intrinsic value, $134, another company with a very nice MOS, at 20% is where we see this right now. That is around $107, and Wall Street themselves are very bullish. Their upside of 46%, indicating a $155 price target, meaning they believe every investor should consider this in their overall portfolio. As always though, do give us your thoughts in the comments below, and don't forget to sign up to those free weekly newsletters, grab those spreadsheets, and come and join us in the Patreon, where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.